Hi there, and welcome to our latest Money Masters podcast segment. I'm Mike Larson, editor-in-chief of MoneyShow, and today I'm speaking with Tom Lee, managing partner and head of research at Fundstrat Global Advisors. Tom, thanks for taking some time out to chat.
Thanks for having me.
Absolutely. Let me start off by saying you were notably bullish when you spoke at our symposium back in February in New York, and clearly the market action since then has validated that view. So now I guess I'm looking for an update on where you stand. I know you just raised your S&P 500 year-end price target to 48.25 from 47.50. So I guess I'll just give you the floor and let you explain why you did that.
We raised the target at the start of this quarter, so right after the first half finished, and we wanted to reflect what we thought was possible to achieve before the end of the year. So an 8% gain would take you to 48.25. Why are we more constructive than most? I think it comes down to a few things. One is, it's our belief that inflationary pressures are easing. I know people have talked about how inflation's been quite sticky. And I think up until now it has been, but I think the internals have been much weaker. So we do think the June is going to be the first time we see some really good progress on core CPI.
Okay.
And the second is, we don't think there's a recession, at least not in the time frame people talk about, which is, people have said it was imminent or around the corner. And I'd say the third reason we're constructive is that, when you look at monetary policy, even though the Fed has been tight, if we're correct that inflation is cooling, that's going to give them some ability to sort of take their foot off the pedal, and it would feel a lot better for investors.
Oh, okay. It's interesting. I also saw you issued, I think it was your first short-term tactical buy call of the year. I was wondering what was the catalyst with that one?
Yeah, it's pretty dicey. We probably haven't done it since my days at JP Morgan, so it's probably been more than 10 years since we issued a tactical buy on any market. But we do think, with some degree of conviction, that CPI this week is going to come in soft, and that's going to allow markets to rethink the path of the Fed and where rates will be. And so I think it's a big deal. And these CPI events have always been market moving, so I think it's going to have some impact on markets, especially because the stock market got really nervous last week after the ADP report. So I think it sort of makes sense that we could have a pretty big move following CPI.
Yeah, okay. Now I know some of the big picture things that you're expecting to drive the market are about the Fed winning the inflation war, the AI boom, and expectation that earnings multiples can expand. Maybe you just want to talk about those in general and just hit on those points and what it is about those three things that have you so optimistic.
Well, on the inflation war, I kind of mentioned, I do think June is going to be the first time that the market might be surprised how much progress has been made on core inflation. That's been sort of a sticking point. And with regard to valuation, I think it's, people say, oh, well, the market's trading at 19 times forward, which is sort of technically correct, but actually that number includes the higher multiples of FANG. And if you exclude FANG, the forward PE is actually 16 times. And 16 times with a 4% 10-year, it's not that demanding. When someone's buying the 10-year bond, they're paying 25 times the coupon.
Yeah.
So historically, the PE should be higher than the 10-year yield.
Let's talk a little bit about Q2 earnings season. Obviously, we'll be getting into the meat of that very soon. Overall, when you look at the fact set commentary, analysts, I think we're looking for S&P 500 earnings to drop a little bit more than 7% year over year. Do you think that's too pessimistic? And if so, what are your expectations for this quarter in the back half of the year?
Well, companies have been beating numbers, so the 7% is going to be too low. But that 7% is because energy earnings are going to be down almost 30%. If you exclude energy, earnings are actually going to be up year over year in Q2. So I think this is going to be, again, it's another example of how people tend to look at the headline numbers and don't appreciate what it actually means. But excluding energy, earnings are up year over year.
It seems like every day there's another story. Like this morning, the Journal's headline, 5 ways the bull market makes investors nervous, and talked about earnings could disappoint, yield curves inverted, blah, blah, blah. I'm curious, where do you stand on sentiment? Do you think that this is a hated rally? And do you think that's something that's fuel for even more gains or no?
Yeah, without question, this is a hated rally. I mean, I think there's a very entrenched bearishness out there and a tendency to think that anyone who's constructive is in denial. Because I think everybody starts their sentence with, "Oh, well, when the recession hits, stocks are going to go down." So I would say that, maybe at the start of the year I could understand bearishness because how horrific 2022 was, and maybe after first quarter, but after June 30, the market's been rising for 9 months now. In fact, by July 26th, the rally will have been longer than the decline, which to me, by no definition, is it a bear market rally at that point. It's actually a new bull market. So I don't know. I mean, sentiment's negative, and I can see it every day, and I can see it talking to institutional investors and talking to retail investors. So, it's been interesting to see how this gets resolved.
Sure. Let's talk a little bit briefly about seasonality. I mean, even some of your fellow bulls, Jeff Hirsch comes to mind. It's looking for kind of a seasonally weak period in the summer, maybe stretching into September, October. Do you think that's something that investors should be aware of, or are you more constructive on how things are going to go here?
No, seasonality is important. I haven't looked at it closely, so I don't have a view, but I mean, you got to respect seasonals for sure.
Yeah. What about the big picture themes? Again, I think when back in February, you hit on a couple points: inflation, immunization, energy security, global labor supplier, and millennials. And those were the big buckets that you then were able to narrow in and zoom in on some individual investment theses or vehicles. Is there anything new that you'd add to that list now, or anything you'd want to expand on those points from back then?
Well, back then, we pointed out that protecting against inflation and also labor shortage, the common thread was FANG because of automation, and I guess now people call it AI, but really the idea that you're trying to protect against those pressures would have led you to FANG. And same thing with millennials. Millennials are really big users of the products created by FANG. So I think those themes still hold. I mean, if anything, in the second half, I think a group that's trailed that should start to do better is going to be energy, because energy's been, it's been hurt by poor earnings and the decline in oil prices, but I think those will probably stabilize in the second half. So that's probably something that starts to work.
So FANG, obviously, I assume you would still be positive on big tech. Energy, you said, would be another group that could start to improve. What else do you really like here?
We like industrials for a couple of reasons. One is that it may not feel like it, but I think the PMIs are bottoming. And historically, whenever you're buying near the bottom for PMIs, that's when industrial stocks do the best. And that's since 1950. So it's a good time to be adding exposure to industrials. And industrials are highly correlated to easing financial conditions. So if the Fed starts to kind of, if the CPI is good and the Fed can start to breathe easier and the members stop being so hawkish, that would lead to easing financial conditions, and that would really help industrial stocks. And the third reason we'd want to own industrials is that, if there is a global recovery, like Europe is emerging and China maybe finally finds some footing, those will benefit multinationals like industrials.
If I did have to, or you did have to put on a pessimist hat, or at least just say what could go wrong, is there anything that worries you or that would throw your thesis off that you see out there?
I mean, labor market's tight. So, the theory for the Fed is, and this is a theory because it's not really how the Fed operated in the past, but that tight labor markets drive inflation. Historically, the argument would be that wages only catch up to inflation. So, maybe we're in a different world, but that would be the biggest risk.
And I guess before we wrap up, I just wondering, would you be able to give maybe a sneak peek? We're about a month out from the investment symposium in Las Vegas this August. Anything that you want to give people an advance heads up about what you might be talking about there?
Well, there's gonna be a lot to talk about. But, keep in mind, by the time we get there, we're already going to be one further hike in, possibly the one hike left in the entire cycle. So, as much as investors think we have to suddenly see markets decline, it's not necessarily aligning with the logic of it.
Well, Tom, really, thank you so much for your insights, and thank you to all who are watching. If you'd like to learn more, hear more from Tom and dozens of other experts, I do encourage you to check out the Investment Masters Symposium. It's going to be at the Paris, Las Vegas from August 8th to August 10th. And you can click the link in the description below to learn how to join us. Tom, thanks again for your time. I hope you have a great day.
Thanks, you too.